and I think we got as low as 6 something on gold. Whatever it was, it had come down about 25%. Oil obviously plummeted from 140 something down to 30 something. So that was the first leg down in the dollar, down 41% under the Bush presidency. Under the Obama presidency, I think we're likely to see something comparable, but it's probably going to be from a higher level. And what I mean by that is, look, the Europeans aren't going to sit around while we continue to pressure the dollar and make Boeing and Caterpillar and John Deere and Microsoft and Apple products so much more competitive than their products. So you begin this beggar thy neighbor, race to the bottom type of policy where everybody else says, hey, I better devalue my currency or my industry won't be competitive. So currencies are always relative to other currencies. The dollar has been the collapsing currency. At a certain point, and I don't know if it's the first half of next year or the second half of next year or maybe even the first half of 2011, but at a certain point, the Federal Reserve is going to say, all right, enough accommodation, enough ZIRP, enough quantitative easing. They'll start to take rates higher, and that'll cause a dollar rally. And when that dollar rally happens, it'll be bad for gold, bad for commodities, bad for stocks. At a certain point, people are going to realize, hey, the dollar's rallied a lot, but we still are looking at massive deficits. We're still looking at an enormous amount of inflation in the monetary supply. Who the hell wants dollars? And so then that prior trend will resume down. So I'm going to say that 6 months from now, the dollar is probably somewhat lower. A year to year and a half, we'll have this big, I'm just guessing on the dates, but so look for near-term weakness in the dollar. At a certain point, we'll see this big counter-trend rally caused by the Fed starting to talk tough on inflation and raise rates, and that's going to be followed by the next leg down, which, I don't know if it's 20, 30, or 40%, but I wouldn't be surprised to see a substantial move down before we get to, let's call it 2015.
Let's talk about base metals and demand out of China. Where do you see base metals a year from now? Are they going to continue to be driven by? Is China for real?
Well, they've demonstrated a couple of things. They've demonstrated they're terrible commodity traders. They top-ticked a lot of the metals, but they're also very crafty negotiators. And they set up a number of relationships around the world, in Africa, in South America, in Australia, obviously, where they want to make sure they don't run out of copper, aluminum, steel. They have, nearly 2 billion people that they have to get off the farm and put on the into cities and into factories, and so they're going to continue to be the maw that needs to be filled on a global basis.
Which metal, like copper? What's a base metal that you like?
Well, if we're talking, by the way, if you look at the precious metals, not the base metals, gold has really been a laggard. If you look at platinum, go down the list: platinum, silver. Gold has actually underperformed many of the other metals, which have really done well. When you talk about the base metals, you got to start and begin with Dr. Copper, who clearly is going to give some insight as to demand, industrial demand, housing demand, electronics demand, and then work your way down: aluminum, steel, etc. I continue to think that they're going to benefit the way the precious metals have from a weak dollar and demand from Asia.
Last two rapid fires. U.S. equities, where are they 12 months from now? Or in any period you feel comfortable with that, because I don't want to.
No, I'm just trying to think of look, this is just a guess. Whenever we talk about future forecasts, it's just a wild guess. But by the way, palladium was the metal I completely forgot about. Palladium has actually done best of all the precious metals, better than platinum, silver, and gold is the laggard of the four. U.S. equities, until we start to see that the Fed is serious about ending ZIRP, about ending quantitative easing, about ending the 24/7 printing press, it's impossible to short stocks into this. You're basically the sell-offs are modest. It doesn't take a whole lot of buying to send stuff higher. One of the things I'll include this slide also. Look, from the peak in October '07 at 14 and change to the pre-Lehman September '08, it was about 8-10 months, and the market fell about 20%. That's what you typically see in a regular recession bear market, about a 20%, 8-month drop. From that post-Lehman, from September to March, you fell 5,000 points in 6 months. That's just a massive collapse. So what we're doing now is unwinding that end-of-the-world panic trade, which is why it's very easy to have things keep going higher with very little buying, why it's so difficult to short anything to this environment. So my best guess is, the rally has another 10, 20, 30% to go. Who knows? But right now the momentum is with the equity market. We're going to then be met by the eventual withdrawal of the accommodation by the Fed, which will lead to, a 20, 25, 30% correction. So the answer to your question is, whenever the Fed starts taking the candy away, the old adage is three hikes and a stumble, 3 steps and a stumble, meaning after the third increase, markets tend to give it up. Although we didn't see that in '02, '03 when the Fed started from ultra low rates, started taking things higher. But at a certain point, the market's going to say, this is our jet fuel, you're taking us away, so we're going to shut an engine or two, and the markets will have to correct. At that point, we'll enter a typical broader trading range. I really look at the current environment as a replay of 73, 74. The parallels are just astonishing, very, very similar, and we'll eventually have the correction, which will be followed by a rally, which will be followed by a correction, and we're setting ourselves up for the next secular bull market, which, if history is a guide, will start anytime between 2012 and 2018. So let's ballpark it and call it 2014, 2015. That'll be the next 15 to 20 year bull market. So your goal as an investor is to preserve your capital till then, to find things that are going up both in nominal and real terms, and to set yourself up for the next 1982, which my best guess is probably about 5 years away from now.
And last one is gold. Before before the Fed starts to tighten and take away quantitative easing and all that, do we see gold get to its inflation-adjusted high? What's the high?
Probably. Historically, commodity rallies tend to surpass their previous inflation-adjusted high. We had 2 short-term targets. We have a 1350 and a 15.25 target on gold. So we obviously think there's more upside. We own a couple of gold miners. We actually like silver. When you look at the ratio of gold to silver, silver's been a laggard. So you can, not over the past 6 months, but historically that ratio is, when it gets cheap, it's nice to buy silver. And palladium and platinum have both been a house of fire. They've been doing really well. I know everybody focuses on gold, but it's nice to be able to purchase a basket of that. Right now you could use ETFs to buy gold and silver, and I think you will eventually see many of the other metals, copper, aluminum, platinum, palladium, purchasable through an ETF, which will give investors something else to think about.
Barry, fantastic having you at the AGORACOM Online Gold and Commodities Conference. Some amazing information here. We ran a little bit of overtime, but that's fine because the information.
My pleasure. It's always a thrill to speak with you, George. We always have a great conversation.
And of course, all of you can see the links to Barry's blog. But for those of you who are listening, in case you're not watching this on AGORACOM and you're catching it somewhere else, Ritholtz.com, Ritholtz.com. Get there. You're talking about a couple of million pages a month are being read over there from pretty high net worth, intelligent investors. I find to be some of the best blogging in the world. And in fact, Barry, you've been ranked. You were ranked the #1 financial blog in the world last year, right?
Yeah, last year. But this year, there's some new upstarts that have definitely been cranking out some good info. You could look at all sorts of other sites like Credit Write-Downs and Naked Capitalism and Calculated Risk and Zero Hedge. they've also been out there. I'm very fond of the blogging community and always try and help all these guys who have something really interesting to say. Look, the Wall Street research has left this enormous void in interesting, analytical, truth-telling research, and the blogosphere is filling it. So I'm astonished they left that niche for us to take over, but it's working out well.
Well, thanks a lot, and for everyone listening, make sure to get yourself over to Ritholtz.com. And Barry, have a fantastic day. Thanks for joining us.
My pleasure. Best of luck with the rest of the conference.
Thank you.